The stock market is headed for an absolute banner year. When we start looking at the benchmark, the S&P 500, it has advanced 27% in 2024 alone, putting it on pace for the best ever performance in the 21st century, which is kind of crazy. And the S&P 500 has really outpaced 4 dozen record new highs this year, including December 2nd. It was a fresh new high with the artificial intelligence boost, with the interest rates that are getting cut. But now the investors are really wondering, and this is a question I'm getting a lot, should you buy the S&P 500 since we're seeing all of these record days and all of these record highs? A lot of people are saying no, and I want to break down this, including what Warren Buffett says about a $150 billion warning to investors as we see this S&P 500 go ahead and progress. Now, when we think of Warren Buffett, he is one of the foremost and really one of the most prominent investors in the world. Under the leadership, Berkshire Hathaway in its Class A has increased 20% every year since the mid-60s. You want to talk about some crazy growth. If you just invested in Berkshire Hathaway in the 60s, it has had a 20% annual growth rate, which of course is almost doubling what the S&P 500 is doing, but the S&P 500 is still doing crazy amounts. Now, when we start looking at some of the biggest contributions, he has a lot of Apple, he holds Coca-Cola, American Express, that he bought for pennies on the dollar when the companies were relatively new. But now thinking of Berkshire Hathaway and their $300 billion stock portfolio and recent capital allocation decisions to really keep some of the money on the sideline and been a net seller in the last 7 quarters. So think about that. When you have one of the most prominent billionaires in the world that has been selling a lot more than they're buying in the last 7 quarters. So we're looking at almost 2 years of them really trimming the hedges and selling over $150 billion, which of course is half of that portfolio. Logical conclusion, Buffett is struggling to find reasonable price stocks that are marking and really running this market up. When we start thinking of the S&P itself, it trades at 22 times the forward earning, a premium to the 5-year average of 19.6. So the valuation of these companies are increasing, and that as a result is driving this S&P 500 to new highs, and we are going to see higher forward P/E ratios, which of course can really correlate to poor performance in the future. And there's a multitude of places that are just getting 3%, that aren't even getting 3%. And a lot of it is being driven by those AI stocks and those larger, really mega sized companies. So when you put this in context, when Warren Buffett drops $150 billion or sells $150 billion of stocks, it's kind of crazy because of the capital allocation that he has and what he can pull. When you look at Berkshire, it's worth $1 trillion plus. Buying into small companies would hardly move the needle for any of those. But when you look at wanting to avoid tech stocks, he doesn't understand some of the technology and really what is coming with AI. And he's chosen to really looking at how overvalued some of these companies really see. A lot of it doesn't make sense when it comes to tech, when it comes to AI, when it comes to what these companies are putting behind artificial intelligence. If we see any drawback, if we see any pullback, it could be very, very detrimental to something like the S&P 500 going into 2025. Now, in addition, there was an article that was written when we looked at correlations between the S&P 500 in 2 consecutive years of double-digit growth. The third year historically, going back to 1926, has been a very big pullback year. They're talking 10, 15, 20% of a pullback in the S&P 500. Now, of course, if you're like me, that is going to give me the ability to buy a lot of the S&P 500. We did this back in 2022 when we started seeing the market decline. As it continued to decline, we continued to purchase it. It got to the point where the market started rebounding in 23 and 24. All of a sudden, the portfolio is up 100% because I did dollar cost averaging when it was going down. Now, you might ask yourself, what is DCA or dollar cost averaging? When it comes to dollar cost averaging, I invest if the market is up, I invest if the market is down. I don't really worry about where the market is and what I'm investing in specifically because I'm worried about a dollar amount. I put X amount of dollars into the market every 2 weeks. Like I said, regardless of the, where we're putting it, it makes a big difference with the consistent, really investments that are going in there. It makes sense, dollar cost averaging. I have my 3 ETF portfolio that we've talked about before. I put money in there and put it on a regular basis. which it's just automatically invested into everything. Now, when we start looking again, his latest letter to the shareholders from Buffett remains a handful of companies that are truly moving the needle at Berkshire Hathaway, and it's essential to pick those over other ones. And of course, when it comes to Berkshire Hathaway, a majority of the stocks are in the United States. He does talk about international stocks, throwing them into the analysis outside of the US. There are essentially no candidates that are meaningful options for capital deployment at Berkshire Hathaway. Think about that. So when we have the United States economy in general, we're roughly 50% of the global economy. He is saying there's essentially no candidates out there in the international market. Now, me personally, I am one that only invests in ETFs, and I do not invest in international markets. Reason being, some of them I don't understand. I don't know the companies. But the big fact is, when you start looking at these big companies, when you look at Apple, when you look at Google, Meta, Nvidia, all of these very large companies are global companies. There is nothing they're doing, that is just in one specific area, one specific company. They are global companies, meaning even when you start looking at McDonald's, when you look at Starbucks, when you look at these companies, they are not just looking at, investing in the international stock market. Investing here, you are investing internationally because those large companies are international companies. So the big picture here, many stocks are historically expensive. So compelling investments options have become increasingly difficult to find. Now, this was true of Tesla many years ago. Shire being a net seller of stocks in the last 7 quarters means that he is not seeing value in those companies, but retail investors have really deployed trillions of dollars into companies like Berkshire Hathaway. In addition, when we start seeing Bitcoin, a lot of people don't want to invest in cryptocurrency, but now we have ETFs. Now we have a lot of different options. So when you start thinking bigger picture in the investment strategy, a lot of places, including BlackRock, are saying Bitcoin and cryptocurrency should be in an investment portfolio, even if it's at a very small amount. We're talking 1, 2, 3%. And I believe specifically they talk about 2% of your portfolio being in cryptocurrency like a Bitcoin ETF and being able to have a little bit of exposure into that market. Now, overall, I know Bitcoin was on the trend and looking at $100,000 that it's going to be valued at, which is kind of crazy because a couple years ago it was 18. We've seen it at 32, and now it is tripled from where that was. So I wish I did put a lot more in there. But again, when it comes to these ETFs, when it comes to Bitcoin itself, I choose not to buy the ETF, but I buy Bitcoin itself. And I do the exact same thing through dollar cost averaging. Every single week, I put $100 into Bitcoin. If Bitcoin's up, I put $100 in. If Bitcoin is down, I do the exact same. I'm putting $100 into Bitcoin, and that is where it is staying, and that is where I'm keeping it for the long term. So when you think about that, 52 weeks in the year, we're putting $5,200 into Bitcoin every single year. Not going to be groundbreaking, not going to be absolutely crazy, but overall, having some exposure into that sector over a multitude of years is, of course, going to grow. So should you invest in the S&P 500? Really, that comes down to the time in the market versus timing the market. If you start doing dollar cost averaging, and you can really have 2 options. One, you can do lump sum investing, just pushing all your money right into the S&P 500 right now at record highs, or you can dollar cost average, which I'm doing even with my investment strategy, $250 a week into the S&P 500, as well as the rest of the 3 ETF portfolios, meaning that I am dollar cost averaging into the position that I have. And again, if it starts coming down, if it continues to decline, I am going to continue to buy it, which is going to be super effective, super cost efficient. And if it does go up, you know what? I'm buying it all the way up as well. Dollar cost averaging is the way to go. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video.